Good morning. Welcome to the Forex Pro Charts weekly analysis for the week beginning November the 14th, 2010. This week we'll be analyzing the Euro JPY pair. As we look at the EJ pair, we see that we have been in a strong downtrend on the monthly chart for quite some time after price hit this top of our playing field. Price has been moving down since then. The last few months it's consolidated and it retraced slightly, but looks like it probably is resuming its downward move. If you've seen our videos before, you know that these solid black lines indicate the outer edges of our trading field. They're the monthly highs and the monthly lows, and we anticipate trading in between these lines until price moves above them and forms new monthly highs and lows. The thick black dotted lines indicate the monthly and weekly armpits on either edge of the trading field. The area in between the monthly armpit and the solid black line indicates the area where we would most likely expect to see price make a long-term price reversal and turn in the other direction. So in this case, the overall trend, as indicated by the 50 EMA on the charts, the overall trend is down, meaning that for long-term price moves we would prefer sells. Of course, for day trades we can take either buys or sells off the 60-minute armpits in our supply and demand zones. Again, price retraced slightly, but looks like it could be continuing back down. If that's the case, if we see that continue this week, we may well be seeing price move down into this area between the monthly armpit and the solid edge of our trading field, which is where we would expect to see price then return in its long-term move back up. Now, looking at the weekly weekly charts, the weekly time period, we see here where price did make that retracement and then kind of started back down. We see the zone pattern that we'll be concentrating on over the next couple of weeks, and what we see is that this zone here that price hit this week has now been crosshatched, and that's because price spiked all the way down through the zone. Now this is a little unusual. It's a fairly new zone. We had just formed it. Price moved out of it up to this resistance zone here and then back down, but spiked through. As you know, once price has spiked through a zone, gone through a zone, then we consider that zone dead and do not trade it anymore. Normally when we mark it dead, price will have continued on down and moved down. In this case, price spiked through, hit the daily trend wall, and then bounced back up. But even so, even though price closed above the zone, it did spike through, and we're considering that zone dead. For taking these bounces off the 60-minute armpits, that just makes the zone too unstable, and the trades off the bounces become much less reliable. And of course, that's the bread and butter trade, is the bounce off the 60-minute armpit, and we don't want to take unnecessary risks. Now we look when we're looking at the chart, we see that if price continues down as we would expect it to do, as we discussed just a minute ago, it comes down to this nice little zone right here where we see on the weekly chart the drop base rally pattern, and it is a fairly small zone with a fairly low risk here from the 60-minute armpit. So this will be a nice zone to trade, and we could well see some significant price movement from this zone because of this pattern. We could see price hit this zone and then attempt to move up back here. If price moves through this zone, then it will be moving down here to this zone, which is just above the monthly armpit. Again, this is also a fairly small zone, although we do not have a 60-minute armpit marked on it, and we'll discuss this zone in a little bit more depth when we're closer to getting to it. We're not likely to come anywhere near this zone this coming week. What would be more likely to happen would be that price would continue its retracement back up. If it does, then we have this nice little zone here where we had a rally-based drop pattern, and probably have a 3-to-1 ratio by the time we get down here. However, you'll see we have already hit this zone one time. It hit the 60-minute armpit and bounced down last week. If it goes back up, that will be the second revisit, and as you know, that makes the zone weaker, and so we would need to exercise caution. Now, it might be okay in this instance, although we don't like really to see it hit again so quickly. We'd prefer to see a couple of weeks, at least a couple of weeks or more, preferably more, past. The longer it's been since prices hit this zone, the more reliable the zone is. So if you are going to trade this zone, if it comes back, we would urge you to exercise caution and move your stops quickly. Now, if price were to move through this zone, as is possible, it would be moving up into this zone, which is an extremely large zone. Some of you like to trade the bounce off of the daily armpit. The risk here is way too large. It's over 400 pips. The risk is way too large to trade the bounce off of the daily armpit. Also, you'll see that on the weekly chart, this is not part of a rally-based drop pattern. It's simply part of a larger downtrend. That means that this zone is weaker. We may be able to see a bounce off the 60-minute armpit, and that's a fairly low risk there because the 60-minute armpit is so deep in the zone. But traders looking for a long-term price movement would not want to trade this zone, and this would be one of the zones where if you sometimes keep your stop dropped back a little bit to in order to account for any brief spikes through the 60-minute armpit and then longer-term moves, in this zone you may want to be a little bit more cautious and move your stop to break even just as quickly as possible. Okay, this is the daily chart, and here you can see a little bit better what we're talking about. You can see here where price spiked all the way down, hitting this extended trend wall, but moving clearly through the bottom of the zone and past all of the armpits. And this is the reason that we crosshatched this zone and marked it as dead. We will take a closer look at the price action when we get to the hourly chart, but next week we'll be removing this zone from our charts. You can see here also where price has already returned to this zone just last week. Nicely went up to the 60-minute armpit and then moved down, and traders were able to get some nice pips off of this trade last week. We're going to take a look at the hourly chart. Probably the only other thing we want to look at, we're looking at a pretty significant drop down to this zone. If price does move back down and continues through this zone, we could see price get to this support zone this week, but it would take some strong price movement. We're looking again at 400 pips, and may not see that much price movement this week. If price does move up to this zone and then come back down, or move up out of this zone and then come back down, we do not want to trade the 60-minute armpit on this zone. We do not want to trade this zone. This zone is dead. Okay, looking at the hourly time frame, and we like to look at this time frame so that we can see the details of price action for the previous week. And we can see here where price came down into the zone, moved past the daily armpit and did bounce a little bit, then came back down past the 60-minute armpit to the 5-minute armpit, and then bounced back up. Now here is something that I just referenced a few minutes ago. You see that price moved back up and did achieve more than the 20 pip bounce off of the daily armpit that we recommend taking for your first take profit. And for our signature trade setup that we recommend for our traders, and we set the parameters of that signature trade up in the most conservative mode possible. And so what we do is we recommend that once you have achieved that 20 pip take profit on the first portion of your trade, that you move your stop to break even on the second and third portion of the trade. Now what happens sometimes, a fairly good portion of the time, you will see price come back down to that 60-minute armpit and just spike through by a few pips, less than 10 pips. In this case, it was only 1 or 2 pips. And then it will move back up, retrace a little, move back up, and move much further up than it did the first time. And of course, these are the price movements that you're looking to capture with that second and third portion of your trade. So while moving your stop to break even works very well when price does not go back down to the 60-minute armpit, there are a number of times where price will come down, spike back through, and then return back up. And this can be very frustrating to traders. One of the reasons that we recommend moving your trade to break even is because then you are guaranteed that 20 pips and you're guaranteed to have that profit. If you do not move your stop to break even, then you are risking the number of pips available in your stop. And when you leave your stop down at the end of the zone, or as we recommend, 10 pips beyond the end of the zone, if price moves all the way back down there and moves down through the zone as it did over here, and as it could easily have done when it returned here, then you are losing more than you gained on the first portion. So by moving your stop to break even, you're protecting your profits from the first portion of the trade, and if you get additional profits, that's great. However, we do have some traders who like to move their stop, but not quite to break even. They may move it within 10, they may move it to within a total of 20 on both of the remaining open portions of their trade. That way they figure they break even they do no worse than break even on the entire trade, and they have the chance to capture those additional pips, which can be quite significant and quite a bit more than the 20 pips on the first trade. This is really a matter of personal preference and your particular trading style. The reasons that we set the signature trade setup the way we did is to be very conservative, to assure getting that 20 pip bounce, which is a very, very reliable bounce, a very high percentage trade, and then to be able to risk-free capture any additional movements if price does not return back to the entry point of your trade. However, if you like a little bit more risk, if you are able to carefully follow the rules, and if you're not making an emotion-based decision, if you have strict rules set up where you move your stop to, say, 10 pips and so forth, then certainly that is up to you and is a legitimate way to trade the charts and trade the 60-minute bounce. However, that should be a rule that you have set up for all trades and that you use consistently, not something that you do based on what price is doing at the time. It should not be a decision that you're making at the time that price is moving. The other disadvantage to this trade, with our signature trade up, you can theoretically set up all your trades at the beginning of the week. Say if you work full-time and you trade part-time, set up all your trades at the very beginning of the week, put in your entry orders, your stops, your limits, and then simply walk away and forget it. Come back the next weekend and see how you did. If you are moving your stop other than break even, that requires a little bit more active management of the trade, because you need to be able to move the stop as soon as you've hit the 20 pips, and you need to be able to then actively manage that trade and continue to move the stop up. Now quickly, we see that price moved up, then returned back to the 60-minute armpit, and we see that in this instance, this is where it moved through the zone, and had you left your trade here looking for a larger, it didn't even bounce at all. Had you traded this again, which we recommend that you don't, trade the second return to the 60-minute zone when it's not left, when it's not gone that far out of the zone. And this is exactly why, because you could have lost more than you had made right here. However, this trade is the trade that we recommend you take. This trade was successful should have been successful for all of our traders, and depending on how you set up your trades, you could have had a very nice pip gain right here. That's it for the EJ this week. For more information or to subscribe to our full analysis and charting services, please go to our website, www.forexprocharts.com, and we'll look for you back here next week on the weekend when we post our next video analysis. Thanks very much. Good luck trading this week.